glad you joined us today. Unit 3 is where we're going to learn all about debt securities, bonds, an important and common way that corporations and governments raise capital to finance their operations and opportunities. Let's get started. In Lesson 3.1, we'll give you an overview of how bonds work, the risks and benefits of investing in bonds, and the different types of bonds available in the marketplace. At their core, bonds represent debt, where the issuer borrows money from an investor and promises to make regular interest payments during the term of the bond, along with the full repayment of principal when the bond matures. The safety and predictability of those regular interest payments is the primary reason that many people invest in bonds. So it's important you understand how those interest payments are calculated and how bond returns are measured. Let's start with a simple example. When someone buys a newly issued bond in the primary market, they always pay the par value, which is always $1,000 per bond. The issuer agrees to repay the par value to the investor when the bond matures, and also to make semi-annual interest payments during the term of the bond. Those semi-annual interest payments are calculated using the coupon rate or nominal yield, which mean the same thing. Those phrases get used interchangeably on the test. The coupon rate or nominal yield is simply the interest rate used to calculate the semi-annual interest payments. So if a new bond is issued with a coupon rate of 3%, all we do is multiply the $1,000 par value by 3% to come up with $30 of annual interest, and then divide it by 2 to come up with $15 of semi-annual interest payments. And don't forget to divide it by 2 on the test, because even though the nominal yield is an annual return, interest payments are always made semi-annually on the test. So you always need to divide it in half to figure out the amount of this semi-annual interest payment. Now, let's say that you bought this 3% bond when it was newly issued, but after a couple of years you decide to sell it. There's just one problem. During the couple of years that you've owned the bond, interest rates have gone up, and investors buying new bonds can get 4% on their money. Now, how are you going to convince someone to buy your 3% bond when they can just buy a new bond that yields 4% instead? Well, one thing you could do is discount the price of your bond. If you sold your bond at a discount, let's just say $900, the investor buying it from you might only get 3% of a nominal yield, but they're also going to get the full par value of $1,000 when the bond matures, even though they bought it at a $900 discount from you. And the difference between the discount they paid and the full par value they receive at maturity might be enough to make up for the lower nominal yield. On the other hand, let's say that interest rates have gone down since you bought the 3% bond. You want to sell it, and newly issued bonds are getting issued with a 2% nominal yield. In that case, another investor might be willing to pay a premium or more than the par value to buy that 3% bond from you. They're paying you extra, even though they're only going to get the $1,000 par value back at maturity. But the fact that they're getting paid a higher interest rate might make up for it. This begs an important question. How does an investor know their yield when they buy a bond at a discount or a premium? One way to figure that out is by calculating the current yield. Now, calculating the current yield is pretty simple. Take the annual interest payment and divide it by the bond's current market value. So, if our bond with a nominal yield of 3% or $30 of annual interest were trading at a discount of $900, we'd take the annual interest of $30 and divide it by $900 to come up with a current yield of 3.3%. On the other hand, if that same bond were trading at a premium of $1,100, we'd take the annual interest payment of $30 and divide it by $1,100 to come up with the current yield of 2.7%. There are other examples of this in Unit 3 in your book, so be sure to go back and review if you want extra practice with those calculations. In addition to current yield, there's also a concept called yield to maturity, which takes into account any gain at maturity that an investor realizes because they bought the bond at a discount, or any loss they realize at maturity because they bought the bond at a premium. You won't need to calculate yield to maturity for the test, but you definitely need to remember that yield to maturity is higher than current yield for a discount bond and lower than current yield for a premium bond. Finally, there's a concept called yield to call. We'll talk more about call features in a couple of slides, but if you remember from your book, a callable bond lets the issuer call it in early if they want to retire the bond before its maturity date. If you paid a premium to buy a bond and the issuer called it in early, you'd lose that premium that you paid sooner than expected, which would cause your return to take a little bit of a hit. You don't need to calculate it for the test, but you definitely want to remember that yield to call is higher than yield to maturity on a discount bond and lower than yield to maturity on a premium bond. The key thing I want you to remember for the test is, first of all, memorize the 4 interest rates in this exact order: nominal yield, current yield, yield to maturity, and yield to call. Secondly, when a bond is trading at a premium or discount, think of a seesaw, kind of like you see on the slide on your screen right now. The rates go from low to high for a discount bond, and they go from high to low for a premium bond. And when a bond trades at its par value, that's the one and only time all of those interest rates are the same. Now, bond maturities can be structured a couple of different ways. In a serial bond, lots of bonds are issued with different maturity dates. So in the example you see on your screen, on the left, a company or municipality might issue $200 million of bonds, and the Series 2030 bonds mature in 2030. Series 2031 matures a year later, and so on. In a balloon bond, there may be a smaller part of the issue that matures early with a bigger balloon payment that matures at a later date. And in a term bond, which is certainly the most common type you'll encounter in the real world, the whole issue matures at the same time. Bond investors are always taking the risk that the issuer may not be able to pay them back when the bond matures. So you'll find that most people are going to want to know a little bit about the issuer's creditworthiness before they make an investment. There are 3 major credit rating agencies that rate bond issuers and the risk they may default on a bond payment. Moody's, Standard & Poor's, and Fitch are the big 3, and Moody's and S&P are the 2 you'll see most frequently on the test. AAA is the best rating an issuer can get from any of the agencies, and the rating scale goes down to AA, single A, triple B, and so on. The key things to remember for the test are that, first of all, the lower the rating, the higher the yield on the bond. In other words, your potential return goes up as the risk of default increases. The second thing to remember, the more A's, the better. AAA is better than AA is better than single A, and so on. And finally, also remember that investment grade bonds are rated triple B or higher. Anything rated double B and below are non-investment grade or junk bonds. Now, the slide you see up on the screen right now just gives you a nice visual of how the bond ratings stack up. The key thing to remember here, again, first of all, the more A's, the better. And secondly, investment grade is anything rated triple B or higher. Now, you might remember that a couple slides ago, we talked about the idea that bond prices move as interest rates change in the economy. Remember, I gave you that example where someone who wants to sell a 3% bond might have to sell it at a discount if interest rates go up after they buy it, or they might be able to sell it at a premium if interest rates go down after they buy it. This idea applies to the entire bond market. So, if interest rates go up, bond prices in general usually go down. And if interest rates go down, bond prices generally go up. To put it another way, bond prices are inversely related to interest rates. When interest rates go one direction, bond prices generally go the other. Now, To take this idea a step further, changing interest rates have a bigger impact on the price of bonds with more time remaining to maturity. Think of it this way. If I have a 3% bond that I'm trying to sell you when interest rates have gone up to 4%, I might have to discount the price of the bond a little bit to get you to buy it if there's only 1 year left to maturity. But what if there's 10 years left to maturity? In that case, I'm probably going to have to discount that bond quite a bit more to get you to agree to take that lower interest rate for such a long time. That's why bonds with a longer time to maturity are more volatile or more sensitive to changing interest rates. So remember that the longer the time to maturity, the higher the premium or the steeper the discount. Also remember that bonds with lower coupon rates are more volatile than bonds with higher coupon rates, because the lower the coupon rate, the more opportunity there is to lose when interest rates keep going up. So to sum it up, to keep it simple, volatility is lower for shorter maturities and higher coupons, and volatility is higher for longer maturities and lower coupons. Now, we briefly mentioned the concept of a callable bond a few slides ago, but I want to give you a little bit more detail here. A callable bond, or a call feature, gives the issuer the option to redeem or call in the bond before its maturity date. You can almost think of it as a refinancing option. Maybe interest rates have gone down since the time the company issued their bonds. If they were issued with a call feature, the issuer would have the option to call them in at any one of the call dates and either just pay them off or refinance them or refund them, as we say in the securities industry. Callable bonds usually come with a higher interest rate than non-callable bonds to compensate the investor for the risk that the issuer may call in the bonds early. Now, while put features aren't as common, they're still important to at least understand the concept behind them. A put feature allows the investor to put their bond back to the issuer before the maturity date, which is essentially a way for the investor to redeem the bond before it matures. Maybe interest rates have gone up since the investor bought the bond, and they want to get their money back to invest somewhere else at a higher interest rate. A put feature allows the investor to do just that. This feature is beneficial for the investor, so bonds with a put feature generally pay a lower return than bonds without it. Finally, a conversion feature gives a bondholder the ability to convert their bonds into the issuer's common stock at a preset conversion price. Now, that's an interesting idea. Normally, an investor that buys bonds tends to be more conservative and want the safety and predictability of regular interest payments. Why on earth would someone like that want to trade in their bonds for common stock? Well, maybe to be profitable. Look at it this way. Convertible bonds give the investor another way to make money. If they want to hang on to the bond and just collect the interest payments, the investor can do just that. But if the issuer's stock price goes up significantly, the investor might discover they can make more money by exercising the conversion feature. Just remember, the cost of the conversion feature is that convertible bonds usually pay a lower interest rate than similar non-convertible bonds. Now, investors that buy bonds are usually attracted to their predictability and relative safety. For anyone that's interested in generating a stable stream of income, like a lot of retirees, bonds can be a good investment choice. The interest payments they provide are usually fixed and predictable, and the issuer is obligated to make those interest payments before they can pay dividends to their shareholders. Bonds also come with a higher degree of safety than equity investments. If the company's ever dissolved, bondholders have priority over shareholders, and the issuer is legally obligated to make those interest payments even if they're not profitable. But even though bonds are safer than equities in a relative sense, they still come with some risks. The first is default risk. Simply, the risk that the issuer isn't able to make the interest payments on time or repay the full par value when the bonds mature. The rating agencies we talked about a couple slides ago try to help investors understand this risk, but it's always something investors need to consider. Interest rate risk is another risk lurking in the background that bond investors need to be aware of. Remember, we talked about the idea that once an investor buys a bond, the interest rate is usually fixed. So if interest rates increase after the investor buys the bond may lose value if the investor tries to sell it on the secondary market at some point in the future. Finally, purchasing power risk, or inflation risk as it's often called, is something bond investors also face. There's no guarantee the interest payments the investor receives will keep up with inflation. One way a bond investor might try to manage some of the default risk associated with buying bonds are by seeking out something called secured bonds. Secured bonds are bonds that are backed by some type of collateral, which helps protect the bondholders if the issuer has difficulty making the bond payments. Mortgage bonds are a type of secured bond that's backed either by real estate or some other type of physical equipment that's owned by the issuer. One little tip for the test: don't confuse this concept with mortgage-backed securities. We're going to talk about those a little bit later in this unit. Mortgage bonds are simply bonds that are backed up with real estate or some other type of physical asset as collateral. Collateral trust bonds are a type of bond where the issuer deposits securities they own, like treasuries or other securities, into a trust account to serve as collateral for the bond. And equipment trust certificates are a type of bond used by airlines or railroads to finance the purchase of their capital equipment, like airplanes or rail cars. The trust owns the equipment, which serves as collateral, and once the bond is paid off, the airline or railroad takes direct ownership of the assets. All of that said, when you look at the broader corporate bond market, the vast majority of bonds out there are unsecured. That means there isn't specific collateral backing the bond. Instead, the bond's just backed by the full faith and credit of the issuer, and the bondholder is considered a general creditor of the issuer. Debentures are the most common type of unsecured bond, and debentures are sometimes referred to as senior debt. When someone owns a debenture, they're a general creditor of the issuer, and the issuer is obligated to make the interest payments as scheduled and return the par value to the investor when the bond matures. Subordinated debentures are sometimes referred to as junior debt. These are subordinated to the issuer's other debt, meaning investors that own a subordinated debenture don't receive their payments unless the holders of the issuer's senior debt get their payments first. As you can imagine, this involves quite a bit more risk to the investor. So subordinated debentures often pay a higher interest rate to compensate investors for that added risk. Guaranteed bonds are bonds that have a third-party guarantee from someone else, almost like having a cosigner on the loan. If for some reason the issuer can't pay, the third party making the guarantee would be obligated to honor the issuer's commitment to pay. Finally, income bonds are a bit of a misnomer because they aren't a good choice for investors that are seeking predictable income. Income bonds are bonds that only pay interest when the issuer has enough income to make a payment. Income bonds are at the bottom of the pecking order in terms of payment priority, and they have the highest risk. These are sometimes used by companies that need to raise capital when they're coming out of bankruptcy, and these bonds are not a good fit for most retail investors. Now, when you go in to take the test, it's important to remember the order in which everyone gets repaid if a company ever liquidates or goes bankrupt. Secured investors always get paid first, or secured creditors, I should say, always get paid first. Remember that secured creditors have some type of collateral backing them, and they can always access that collateral before anyone else can. Once the secured creditors have been repaid, then the company repays its general unsecured creditors, which includes most of their bondholders that own debentures. And once all the issuer's general creditors have been repaid, then any junior debt gets repaid, which are the subordinated debentures that we talked about on the last slide. Then, if there's anything left over after all the debts have been settled, the preferred shareholders and then common shareholders after that get to divvy up anything that's left. The key here is just to remember the order in which you see everything listed here on the slide, who gets paid first, who gets paid second, and so on. Private corporations aren't the only ones who access the bond market to raise capital. Government entities also turn to the bond market to raise lots of money to fund their ongoing operations and obligations. Governments need to build schools, roads, airports, and other infrastructure, and investors in the bond market are an important source of capital for these types of projects. In this unit, we're going to teach you all about government-issued bonds, both municipals, which are issued by states and local governments, and treasuries, which are issued by the federal government. Municipal bonds get issued by states, counties, and municipalities to raise capital for the wide range of expenses they incur. One very important feature of municipal bonds is that they're federal income tax free. On top of that, they're often free of tax at the state and local level if someone buys a bond issued by a municipality in their state of residence. Municipal bonds usually pay a lower interest rate because of this special tax treatment, but they're very popular with investors in high tax brackets that are investing in a taxable account because sometimes the tax savings can more than compensate for the lower interest rate. Municipal bonds come in two important varieties. The first type, called general obligation bonds, are backed by the full taxing authority of the issuer. They're usually issued to fund general spending and capital projects that benefit the community at large. Repayment of general obligation bonds is backed by state or local tax revenue, and voter approval is sometimes required before a municipality can issue them. On the other hand, revenue bonds aren't backed by the taxing authority of the issuer. Instead, they're used to fund the construction of a public facility that will generate its own revenue, like stadiums or airports. Repayment of a revenue bond is only backed by the revenue generated by the specific facility or project that they were issued to build. In addition to issuing longer-term bonds to finance longer-term projects, municipalities sometimes issue shorter-term debt securities to fund shorter-term needs. I don't want you to worry about being an expert on every single one of these for the test, but there are a couple of easy things I want you to remember. First of all, you see a lot of these are referred to as some type of anticipation note. The idea here is that they're being issued to raise capital in anticipation of receiving revenue from a longer-term source, and the short-term debt gets repaid when that longer-term revenue gets collected. So, for example, a bond anticipation note raises money in the short term, anticipating it'll be repaid when a long-term bond issue closes. Likewise, tax anticipation notes raise money in anticipation of repaying it when tax revenue gets collected. Again, I don't want you to worry about being an expert on each one of these. Just remember they're all short-term and they get repaid with whatever revenue they were issued in anticipation of. At the beginning of the unit, I mentioned that interest from municipal bonds is tax-free at the federal level, and sometimes it's even tax-free at the state and local level when someone buys municipal bonds from an issuer located in their state of residence. This tax benefit is very attractive to investors in higher tax brackets. The tax benefit begs an important question. Which bond is a better deal for your client? A taxable corporate bond that pays a higher interest rate, or a tax-free municipal bond that pays a lower interest rate but that comes with that nice tax benefit? The answer depends on your client's tax bracket. Let me give you an example here. Let's say that you have a customer that's in a 40% tax bracket and they're looking at a taxable corporate bond that pays 10% interest. They receive $100 of interest per year, they pay $40 in taxes on it, and they're left with $60 after they've paid those taxes. Now, on the other hand, they might also be looking at a municipal bond that pays 6% interest. While that's a much lower interest rate than the corporate bond, they don't pay any tax on it, so they're left with the same after-tax return as the corporate bond. As you might be picking up on here, which one is a better deal can vary based on what tax bracket an investor is in. In order to figure out for sure which one is a better deal for any given investor, you need to be able to figure out something called tax equivalent yield. The math here is pretty simple. Let's take a corporate bond that's yielding 8% and compare it to a municipal bond yielding 5%. If the investor's in a 20% tax bracket, which one's a better choice? Here, we take the corporate return of 8% and multiply it by 100 minus the investor's tax bracket. So here, if the investor is in a 20% tax bracket, 100 minus the investor's tax bracket of 20% is 80%. So the corporate return of 8% multiplied by 80% leaves us with a tax-free equivalent yield of 6.4%. So in this case, the corporate bond is a better deal. Getting 8% from the corporate bond and paying the tax leaves the investor with a 6.4% return, which is still more than the 5% tax-free return from the corporate bond. Of course, if the investor was in a higher tax bracket, the answer might be different here. So let me show you what would happen if the investor was in a higher tax bracket. Let's use the same 8% taxable corporate bond, but let's say the customer's in a 40% tax bracket rather than the 20% bracket we used in the last example. Here we use the formula of corporate bond yield, which is 8%, times 100% minus the investor's tax bracket. As you can see, because the investor's in a higher tax bracket, the tax-free equivalent yield is only 4.8% for the corporate, so the 5% tax-free yield on the municipal bond would be a better deal for this particular customer. Now, the last example showed you how to take a taxable corporate bond and figure out what the tax-free equivalent yield would be. In this example, I'm going to show you how to do it the other direction and take a tax-free municipal bond and show what its taxable equivalent would be. Here we take the tax-free yield and divide it by 100 minus the divide it by 100% minus the investor's tax bracket to come up with the taxable equivalent. So a 5% tax-free yield here gives us an 8.33% taxable equivalent for an investor in a 40% tax bracket. Let me give you a couple more quick examples just to make sure this is soaking in. Let's go back to our 8% taxable corporate bond, but let's say the investor's only in a 20% tax bracket. Here, we take the taxable rate of 8% and multiply it by 100% minus the customer's tax rate of 20%. So 8% times 80% leaves us with a tax-free equivalent yield of 6.4%. For this investor, a tax-free municipal would only make sense if it was yielding 6.4% or higher. And one final example to show the taxable equivalent on a tax-free municipal. Let's take a 5% tax-free return on a municipal bond for someone in a 20% tax bracket. We take the tax-free return of 5% and divide it by 100% minus the customer's tax bracket. So here, 5% divided by 80% equals a taxable equivalent of 6.25%, meaning a taxable corporate bond would be a better deal for this investor if it yielded 6.25% or higher. When any investor is looking for a safe haven for their money, U.S. Treasuries are usually the first place they turn to park their money. Treasuries are backed by the full faith and credit of the United States of America. The secondary market for U.S. Treasuries is deeper than the market for any other type of security out there because there's literally trillions of dollars of outstanding debt to trade hands. U.S. Treasuries are negotiable, which means they're marketable and can be traded freely at any time, and ownership is easily transferred in book entry form. Interest received from U.S. Treasuries is taxable at a federal level, but tax-free at a state and local level. Treasuries are issued with a variety of maturities ranging anywhere from 4 weeks to 30 years. Treasury bills are the shortest term treasuries that are available, and they're issued with a duration of 365 days or less. The U.S. government auctions off and issues new treasury bills on a weekly basis, and they're commonly issued with terms of 4, 8, 13, 26, and 52 weeks. Treasury bills are zero coupon securities, which means they don't make regular interest payments. Instead, they're always sold at a discount to their par value, and the difference between the discounted price at purchase and the full par value paid at maturity represents the investor's return. Treasury notes are medium-term treasuries with terms of 2 to 10 years. These get issued at par value and make fixed semi-annual interest payments. That interest rate gets set at auction and is fixed for the duration of the term. Like most other bonds, Treasury notes return their full par value to the investor when they mature, along with the final interest payment. Treasury bonds are long-term securities that are issued with a term longer than 10 years. Like Treasury notes, these make fixed semi-annual payments, and the full par value is returned to the investor at maturity. TIPS, short for Treasury Inflation Protected Securities, is a type of treasury that gives the investor some level of protection against inflation, which is kind of a hot topic right now. Like Treasury notes and bonds, TIPS are issued with a fixed interest rate for the duration of the term, but the par value gets adjusted on a semi-annual basis to reflect changes to the consumer price index. So, if someone bought some TIPS with an initial par value of $1,000 and inflation had been running at 5% during the first 6 months, the par value would be adjusted upward to $1,025 at the first semi-annual date, and the investor would receive an interest payment calculated off that increased par value. This keeps happening on a semi-annual basis so that the par value and the corresponding interest payments are always keeping pace with whatever's happening with inflation in the economy. And when TIPS mature, the investor receives the adjusted par value at maturity. Once in a while, someone will ask, okay, that sounds pretty cool, but what happens if there's deflation? In the rare case where deflation occurs, the par value would technically be adjusted downward, but you're always guaranteed to get back at least the original principal amount when TIPS mature. To know about each one. Ginnie Mae is sometimes called GNMA, or the Government National Mortgage Association. And it's a government corporation that guarantees the timely payment of principal and interest on mortgage-backed securities. The key points I want you to remember about Ginnie Mae are, first of all, these are mortgage-backed securities, and secondly, these make monthly payments to investors that are a combination of interest and principal. Third thing I want you to remember about Ginnie Mae is these are the only ones on this slide that are backed by the full faith and credit of the United States, so they're pretty safe. And finally, interest is taxable at all levels, federal, state, and local. Now, just to the right of that, the Farm Credit Administration is a government-sponsored enterprise that helps to facilitate lending to farms and the agricultural sector here in the United States. The two things I want you to remember about Farm Credit Administration bonds are, first of all, these are not backed by the full faith and credit of the United States. So while they're still pretty secure in the grand scheme of things, they're not quite as secure as treasuries. And the second thing I want you to remember about FCA bonds are that interest is taxable at a federal level, but tax-free at a state and local level. Now, third one over, Fannie Mae and Freddie Mac. That's our third and fourth one over here to the right. These are government-sponsored enterprises that help to provide liquidity to the mortgage market. Both are chartered by the U.S. government, but operate as private, shareholder-owned companies. For both of these organizations, just remember that, first of all, these are not backed by the full faith and credit of the U.S. government. Secondly, with both, payments get made to bondholders semi-annually, and those payments are a combination of principal and interest. And finally, remember that interest is fully taxable at all levels. Finally, money market securities are short-term debt obligations with less than 1 year to maturity. The money market is very liquid, and it consists of high-quality debt. Investors that are looking for someplace to park their money that's safe and highly liquid often put their money into a money market mutual fund, which invests in these types of money market securities. Treasury bills are one form of money market security that we've already discussed that are very safe, secure, and liquid. Also, just to prep you for the test, Treasury notes and bonds may be issued with maturities of 2, 5, 10, 20, or 30 years, but if they only have 1 year or less to maturity, they're also considered money market instruments. So we can always assume that Treasury bills fit into the category because they always mature in 1 year or less, but don't get tricked on the test. Treasury notes and Treasury bonds also fit into the category if there's only 1 year or less left to maturity. Commercial paper is another type of money market security that's unsecured, short-term corporate debt with 270 days or less to maturity. It's usually issued by very high-quality companies that are looking to raise capital on a short-term basis to fund their short-term operating expenses. A third type of money market security you also want to be aware of are called jumbo CDs. These get issued by banks with a $100,000 minimum face amount, and they're usually issued with face amounts of $1 million or more. These aren't the CDs that ordinary bank customers buy. They're usually issued in large amounts to institutional investors like money market funds, and they're negotiable, which means they can trade on the secondary market. Finally, bankers' acceptances are used to finance foreign trade. Like commercial paper, bankers' acceptances usually have a maturity period of 270 days or less. All right, collateralized mortgage obligations, or CMOs as they're sometimes called, are a form of asset-backed security that allows investors to invest in mortgages. Essentially what happens here is investment banks pool mortgages and structure them into different maturity classes called tranches. If you're going on to take the Series 7, CMOs get tested much more heavily there than they get tested on the SIE. And we'll certainly cover CMOs in more detail when you take the Series 7 class. For our purposes today for the SIE, we can keep it simple. Just remember a couple of quick key points here. Firstly, collateralized mortgage obligations are backed solely by the repayment of the underlying mortgages, and there isn't any form of government guarantee if the mortgages go bad. Secondly, the underlying mortgages are sorted into different tranches which have different risk profiles and different maturity dates. This means an investment in a CMO could be fairly conservative or fairly high risk, depending on which tranche an investor puts their money into. Thirdly, CMOs make monthly interest payments to investors, but repayment of principal varies based on which tranche an investor bought into. The fourth thing I want you to remember here is that there are special disclosure and suitability rules because of the unique risks associated with CMOs. And finally, just remember that CDOs, or collateralized debt obligations, are a closely related cousin of CMOs, where investment banks pool other types of collateralized loans, like car loans. Again, we'll talk about these in more detail if you're going on to take the Series 7, but what we talked about here is all you need to worry about keeping straight for the SIE. So to sum it all up and close out the unit, here's a nice summary chart that brings everything together that we talked about relating to the taxation of interest payments and how frequently interest gets paid. So, who's ready for quiz time here at Kaplan? Let me throw a couple of questions out to you. Let's see if you can get these right. So the first question up here on your screen, which of the following is true for a 6% bond priced at $960 in the secondary market? 1, annual interest is less than $60. 2, annual interest is $60. 3, current yield is less than 6%. Or 4, current yield is greater than 6%. Uh-oh, multiple correct choices here. So is it A, is it option 1 and 3? Is it B, options 1 and 4? Is it option C, which would be 2 and 3? Or D, which would be 2 and 4? The answer, everybody, drum roll please, is D. The correct answer is D. Options 2, which means that annual interest is $60, and option 4, which is that the current yield is greater than 6%. All right, our next sample question. Treasury notes have maturities of A, 1 year or less, B, 2 to 10 years, C, 10 years, or D, greater than 10. Anybody want to take a wild guess here? Again, where's our pseudo drum roll? Correct answer to that is B, 2 to 10 years. And also remember, Treasury bills, those have the maturity period of 1 year or less, and Treasury bonds longer than 10 years. And now question 3. One of the benefits of owning a municipal bond is that interest is always tax exempt at the federal level, A, state level, B, state and local level, C, or federal, state, and local level, which is D. Who wants to answer that one? The correct answer is A. Now let me explain this one for just a minute. Municipal bonds are always tax-free at a federal level. They may be tax-free at a state level if the investor purchases bonds that were issued in their state of residence in the state where they pay state income tax. But if an investor buys municipal bonds issued in a different state, it is possible that their state may want to tax that at the state level.